Hey, this is Stephen, one of the managing partners here at Prospective Capital. Every week, I put together a video on investing topics, and wealth in general, just to help you become a more better informed investor and to better understand what's going on and where's the best place to place your money. And so today, the topic that we're going over is internal rate of return. I get this question a lot talking to investors. They ask me, what is internal rate of return? Or a better way to maybe express it is people want a way or a means of comparing the investments that we offer when it comes to multifamily real estate and private funds versus, say, the stock market, which is more transparent, easier to measure on a day in, day out basis. And so the best way for us to do this, or an industry standard, is to typically use a formula called internal rate of return. And the layman way of explaining what internal rate of return is just to think of it as what I am compounding my money at per year. And so in order to explain it a little bit more in depth, I'm going to show you just how it's calculated in some basic formulas, basic numbers, just so we have a better understanding. So I should have shared my screen with you. You should see an Excel sheet here. And right here, it should say internal rate of return, or IRR. Here we have year zero. That's the initial period that we invest our money. And so in this example, we're investing $100,000. That's why it's negative. Now in year one, we're saying we're getting no dividend in year one, year two, year three. But in year four, we're selling this investment and we sold it for a gain. We sold it for $110,000. So we recouped all of our initial $100,000 investment, plus we got $10,000 on top of that. Now, if I ask you the question, okay, what did you make per year in terms of a percentage? How do you answer that? The way that we answer that in all of finance typically is using this calculation called internal rate of return. And so in this case, this would be, the equivalent of compounding our money at 2.4% per year. Now, if we want to double check this math, how can we double check this math? Pretty easy. We start with 100,000 in year zero. That's what we initially had. That's the value. And then we multiply it by this percentage, and we grow it by 2.4% per year, every year over that time period, and we get to 110,000. Now, the thing that's important to know, especially when it comes to multifamily or just real estate in general, is typically you buy real estate because you like cash flow. Here at Prospective Capital, we're a long-term investment company that invests in multifamily real estate because we like cash flow. So what that means is that typically we're not going to have an investment that doesn't produce any income in year 1, 2, and 3 if we give a 4-year time horizon. Typically, it's going to produce something in between. So let's say that it produces something in between. And in this example, we can say it produces $3,000 per year in terms of a dividend, okay? So if we add that in, what are we making then? Well, that changes the rate that we're compounding money to 4.6%. So it's about 2.2% higher than what it was before. Now, I personally would not be happy with a 4.6% rate of compounding. That would not be cool. That would not be okay. So it's probably, the investments that we make are going to probably be way higher than that. But for illustrative purposes, you can see that just having those dividends changes the scenario quite a bit in terms of what we're compounding it at. Now you're going to ask down here, why is this number change? Well, this assumes that we're reinvesting these dividends here in an investment that's making this amount of money. So this is pretty important to know. In order for us to actually achieve this 4.6% rate of compounding, we have to reinvest dividends in an investment that makes this amount of money, or is compounding at that, or is growing at that, whatever phrase you want to use. Right here, 4.6% is very realistic to beat, especially in real estate. We're probably going to be significantly higher than that. I typically try to shoot for 15% or better when it comes to IRR, when it comes to compounding my money. Otherwise, why wouldn't I just invest in the stock market? Okay. Anyways, I wanted to go over this calculation here because it's pretty important when it comes to calculating and evaluating investments. Typically, the stock market makes somewhere around 7 or 8% per year, especially if you have an investment advisor. That's the rate that it's going to grow at. So you could analogize or something like that. You could compare, a stock investment if the stock market is so if the stock market has a IRR that is, let's say, 7%. Now we have a way of, and this is real estate up here. Let's see. If this is real estate, now we can compare our real estate investments to the stock market and actually kind of be able to measure them one against each other a little bit better. This is what your total money actually turns out to be if you compound it at 4.6% per year. Now, our investments might look a little bit closer to I don't even know if I can do this off the top of my head and get it close. Okay, now let's say this is still hypothetical. Now say that this is our investment. We invested $100,000. We're going to make 10% cash on cash return every year, and then we're going to sell the investment for $150,000. That would mean that we're compounding our money at about 7.7%, or that we took our $100,000 and we turned it into $200,000, just under. So the next calculation that you would actually see out of real estate typically is called an equity multiple. And to explain that to you, that would just be the best way to do it is just if I said the equity multiple on this is 1.91, that would mean that the first one is all of your money recouped, and then after that is your percentage gain. So another way to look at that would be subtract out the 1, and you have a 91% increase in value over 4 years. Okay, if you're compounding it at 17.7%. I don't really look at this as much. I mean, I do. I understand what it is, and I'm aware of it, but I take the whole thing in perspective, and typically my main focus is to compare this IRR to what I think the stock market generally on long-term average can do, net of an advisor fee. So maybe it's 8%, 9%, going to subtract off a 1% advisor fee. That gives you a net IRR of about 7% in terms of the stock market. So if I can do this, or even if I'm significantly less than that, even if I'm 12%, I'm still more happy with this than I am with this. Last thing that I'd like to cover in this pretty quick video is that when we're comparing a real estate IRR that has cash flow in these years, is that this cash flow is very valuable. Okay, it's more valuable than what this IRR might make it seem to be. Even if we took this to 7,000, okay, and we were at 15.5. Even if I took it to 4,000, and we're at 13.4. The reason that this is more valuable is that this is income to you. Okay, you can live off of this. Appreciation is much more difficult to live off of because you have to sell it. So this $4,000 drip every year or $1,000 a quarter is way more valuable than what can get caught up in just the IRR. You can take this to the bank, and the bank sees it as income. That allows you to go and, borrow money if you need to borrow money from the bank because you have something to support it, right? It allows you to pay utility bills or take a vacation or something like that without having to sell your asset. So I just wanted to jump on here today, create a video to kind of address and let me exit out of the screen. address this question that I get quite a bit, which is what is IRR? What is an equity multiple? How do I compare my real estate investment to the stock markets to make sure that I'm making the best investment for myself? Hopefully this explained it a little bit better. If not, I'm sure I'll make another video on this not too long in the future. But I really wanted to jump on here and answer that question because it's one that I get quite a bit. And I hope that this helped you out. Anyways, I'll see you next week. Thanks.